Hey, enthusiasts! Welcome back to our Indian stock market series. Today, in part 4, we'll decode the options market. If the term options trading sounds intimidating, don't worry. By the end of this video, you'll understand it like you've known it for years. Let's begin. What are options? Think of options like booking a movie ticket. When you buy a ticket, you reserve the right to watch the movie at a specific time. But if you change your mind and don't show up, the theater doesn't force you. You just lose the ticket price. Similarly, an option is a contract gives you the right, but not the obligation to buy or sell an asset at a specific price before a certain date. Options are of two types. Call option, right to buy, expecting price will go up. Put option, right to sell, expecting price will go down. You pay a premium to own the option, like paying for the movie ticket. If the market goes your way, you can make profit. If not, your loss is limited to just that premium. Buying versus selling options. Options trading has two roles, buyers and sellers. Option buying is like purchasing insurance. You pay a premium for protection for a potential benefit. It's low risk. Option selling is like being the insurance company. You earn the premium but may have to pay a lot if things go wrong. Now, let's discuss what is an option chain. This is option chain, a table that shows all the available option contracts for a particular stock or index, like Nifty or Reliance. In an option chain, you see different strike prices, call options, put options, and various other components. Let's break down. On the left side, you'll see call options. And on the right side, you'll see put options. Strike price. This is the price at which you agree to buy or sell the stock later. A TM at the money. This is the strike price closest to the current market price. ITM in the money. For call options, the strike prices less than market price are ITM. For put options, the strike prices greater than market price are ITM. OTM, out of the money, are exact opposite of ITM. For call options, strike prices higher than market price are OTM. For put options, strike prices lower than market price are OTM. They're cheaper but riskier. Now you might have the question, which strike should I trade? Always prefer ATM and ITM for option buying and OTM for option selling. But why? You'll get to know that in some time. Premium or LTP, last traded price. This is the price at which that option can be bought or sold. Open interest, OI. This tells you how many open positions exist at a strike price. Higher OI equals more interest in that option. For example, if 6,68,000 traders have position in 53,500 put option, the OI is 6.68 lakh. Expiry date. Options are not forever. They expire on a fixed date. Example, the Bank Nifty options you're watching now are going to expire on the 29th of May of 2025. Always check the expiry date before entering a trade. PCR, put-call ratio. PCR stands for put-call ratio, and it's a quick way to see market sentiment. It is calculated as total put-open interest divided by total call-open interest. If PCR is more than 1, that means more puts are open. Market may be bullish. If PCR is less than 1, that means more calls are open. Market may be bearish. Example, if PCR is 0.73, then it's slightly bearish sign. What are option Greeks? Option Greeks are like tools that help option traders measure risk and understand how different factors affect the price of an option. Similarly, option Greeks tell us how sensitive the option's price is to things like stock movement, time, and volatility. Delta. Delta tells us how much the option price will move when the stock price moves. Example, If a call option has a delta of zero point 0.5 and the stock moves up by 10 rupees, the option price will go up by 5 rupees. Call options have positive delta and put options have negative delta. Usually, ATM have delta of zero point 0.5, goes on increasing for ITM and decreasing for OTM. Theta. Theta, the silent killer for option buyers. Theta tells us how much value an option loses every day as time passes. Example, if theta is -5, your option will lose 5 rupees in value every day, even if the stock doesn't move. This is called time decay. Option sellers love theta. Option buyers, not so much. OTM strikes have higher theta compared to ITM and ATM. This is why one should trade ATM or ITM strikes while buying options. Gamma. Gamma tells us how fast delta is changing. Let's say delta is the speed of your car, then gamma is the acceleration. If gamma is high, delta can change quickly, which means the option can suddenly become very sensitive to stock price moves. Vega. Vega measures how much the option price changes when volatility changes. High volatility means more potential movement, and options become more expensive. Think of it like a roller coaster. The crazier the ride, the higher the ticket price. Rho. Rho tells us how much the option price changes when interest rates change. To be honest, Rho is usually the least important for regular traders. But it's good to know. If interest rates go up, call options usually become more valuable. Summary. Delta is price movement. Theta is time decay. Gamma is delta's speed. Vega is volatility effect. Start with delta and theta. They're the most important. That's a wrap on part 4. Now you know what options are, the difference between buying and selling, how to read the option chain, and the basics of option Greeks. Like, subscribe, and hit the bell icon. See you in the next one.